Okay, let's dive right into this explainer. Today, we are putting Carrier Global through our ultimate stock valuation stress test, the Guru Gauntlet. You see, it's one thing to spot a great company, right? But it's an entirely different challenge figuring out what that company is actually worth. So we're going to step into the shoes of history's greatest investors to do a complete, deep dive analysis on Carrier Global.
To do this, we'll evaluate Carrier through 5 distinct lenses, starting with a quick company snapshot, then applying the frameworks of Buffett, Lynch, and Graham, looking at modern DCF valuation models, and finally synthesizing it all for our final verdict.
Section 1, Company Snapshot, looking at Carrier Global, ticker symbol CAR. Sitting at a current price of $66.98, with a market cap of over $55 billion, this 120-year-old company is an absolute giant in air conditioning and refrigeration. I mean, they literally invented modern air conditioning back in 1902, and they've grown into a dominant global player ever since.
What's really fascinating right now is this massive strategic pivot unfolding behind the scenes. Carrier is actively divesting its non-core assets, like its fire and security businesses. Why? Well, because they realize that capital and management attention is way better deployed purely into their core HVAC and data center cooling markets. It's a classic case of laser focus beating out broad diversification.
And just listen to this incredible quote from CEO David Gitlin during their Q1 earnings call. He said, "Orders in our global commercial HVAC business increased 35%, helped by data centers which were up over 500%. You heard that right. An explosive 500% surge in data center cooling orders. That is the kind of monstrous macroeconomic tailwind that completely reshapes a growth trajectory. But does that make the stock a buy? Let's ask the masters.
Section 2, the Buffett lens. Here, we're searching for that classic Buffett setup, a wonderful business with a wide economic moat, honest management, and a solid margin of safety.
Before we do the math, we have to define owner earnings. Think of this as the free cash flow actually available to the owners after required capital expenditures. Carrier projects this will hit a staggering $2 billion for the full year 2026. Buffett loves businesses that generate mountains of cash, and Carrier definitely fits the bill here.
Running through his qualitative checklist, Carrier looks pretty great. Dominant global HVAC market share? Check. Shareholder-friendly management? They just returned $500 million to shareholders in Q1 alone. Earnings are highly consistent with a guided $2.80 EPS, and we're assuming roughly a 20% return on equity. But there's a catch. Buffett would likely raise an eyebrow at their $12.57 billion debt load. It's manageable given their cash flow, sure, but it's not the pristine balance sheet he usually demands.
So here's the bottom line for the Oracle of Omaha. While he'd absolutely respect the business economics, his strict rule for a 10% owner earnings yield plus a generous margin of safety means he wouldn't even think about buying unless the price dropped to $16.60. He wants wonderful businesses, yes, but only at wonderful prices. At nearly $67 a share, it's priced way out of his conservative comfort zone.
Section 3, the Lynch lens. Let's shift gears and use Peter Lynch's framework to see if Carrier is a hidden gem growing at a reasonable price.
Lynch is famous for the PEG ratio. That's the price-to-earnings multiple divided by the growth rate. He loves a PEG of 1 or lower. Well, Carrier currently trades at a PE of about 23.9. Even if we give them a generous 12% assumed forward growth rate driven by that data center boom, the PEG ratio lands at roughly 1.99, so the multiple is outrunning the growth. Not exactly the screaming bargain Lynch actively hunts for.
Categorically, though, Lynch would probably see Carrier transitioning from a steady stalwart to a fast grower. It's actually kind of ironic, right? A 120-year-old traditional AC company suddenly becoming a hot tech-adjacent play. But hey, that is exactly what 17% annual industry growth in data center cooling will do to a legacy business.
Looking at the balance sheet, though, total debt has ballooned significantly from $1.16 billion in 2019 to $12.57 billion today, compared to just $1.37 billion in cash on hand. Lynch really prefers cash-heavy balance sheets to weather economic storms, so this rapid debt expansion changes the narrative a bit.
Because of that debt and the fact that institutional ownership is already massive at this $55 billion size, Lynch would likely label Carrier a hold. It's a fantastic company, no doubt, but it completely lacks that under-the-radar profile he famously profited from, and it's already fully priced for the growth it's seeing.
Section 4, the Graham lens. Time to apply the uncompromising, hyper-conservative math of Benjamin Graham, the father of value investing.
Running Carrier through Graham's strict defensive investor checklist builds some real tension. It passes easily on adequate size, earnings stability, and its 96-cent annual dividend record, but it spectacularly fails on strong financials because that massive debt vastly outweighs its net current assets. It also completely fails the valuation multiples. Graham wants a PE under 15. Carrier is at 23.9. He wants a price-to-book under 1.5. Carrier fails that too.
To get the exact number, we plug Carrier's guided $2.80 EPS and our assumed $8 book value per share right into Graham's famous intrinsic value formula, the square root of 22.5 times earnings times book value. The formula spits out a strict baseline intrinsic value of just $22.45 per share. That is the absolute maximum Graham believes the underlying fundamentals are worth today, completely stripping away all that future data center hype.
But remember, Graham invented the margin of safety. To get his mandatory buffer, he wouldn't even touch this stock unless it plummeted to around $15. In today's growth-obsessed market, a true Graham value play on Carrier is honestly just a mirage.
Section 5. DCF and Alternative Valuation Models. Let's step into the modern era and project some future cash flows to see if the current price makes sense.
Building a base case discounted cash flow model, if we assume 9% growth over the next 5 years, a standard 3% terminal growth rate, and a 9% weighted average cost of capital on that $2 billion in free cash flow, we land at a fair value of $40 per share. And look, even if we push our sensitivity table to a super optimistic 4% terminal growth and an 8% discount rate, we still can't bridge the gap to that high 60s share price.
When we cross-reference this with alternative models, the story really doesn't change. Applying an 18x peer multiple, using competitors like Trane Technologies and Johnson Controls, gets us a comparable PE model price of $50.40. Meanwhile, a standard dividend discount model, assuming 6% dividend growth and a 9% cost of equity, sits way down at a conservative $32.00.
Section 6. Synthesis and Final Verdict. We've run the Guru Gauntlet, so let's look at the final scoreboard.
As you can clearly see here, every single one of our valuation models falls significantly short of the current $66.98 trading price. From Graham's ultra-conservative $22.45 all the way up to our peer comps at $50.40, there is a glaring disconnect between the mathematical intrinsic value and the premium the market is currently demanding. So, our final impartial verdict for this explainer is a hold. Make no mistake, Carrier is a phenomenal business. They are perfectly positioned for the future, trimming the fat off their non-core units and absolutely dominating the exploding data center cooling market. But with $12.57 billion in debt and a share price soaring above every traditional valuation metric, you have to ask yourself, is this stock already priced for absolute perfection, and what happens to your investment if they deliver anything less?